Hey YouTube, welcome back to my financial focus. In this video, I'm going to be talking about a few different stocks that have beaten the market over the last 3-month correction and over the last year. So some of these stocks are up during the period and some of them are also down, but at most they're only down about 4 to 5% from their all-time highs. We can see right here that the market return for the S&P 500 comes out to be about 14% over the last year. And just keep in mind that all of the businesses that I list in this video, they all have very strong financial health and they've had positive earnings and revenue growth from 2020 to 2021. So the first business that I want to talk about is Berkshire Hathaway. And by the way, leave a like on the video, it really helps this video out and get out to more people. Okay. So first stock is Berkshire Hathaway, and this is pretty popular. This is Warren Buffett's conglomerate holding company, and their top holding is Apple, which makes up about 49% of their portfolio, but they also hold a bunch of different stocks as well. And we can see that over the last 3-month period, where the overall market declined by about 2%, Berkshire Hathaway is up about almost 20%, which is pretty impressive. And over the last year, they're up 35% compared to the market's 14%. And we can see from this discounted cash flow analysis that I've done based on some growth estimates pulled from Yahoo Finance, as well as some cash flow estimates pulled from their financial statements, that their intrinsic value per share based on these calculations, discounting the cash flows back by a discount rate of 10%, comes out to be $590 per share with a 50% margin of safety of $296 per share. So if we wanted to buy in at the intrinsic value per share for Berkshire Hathaway, we would want to buy in at around $600 per share. And so anything less than that could be considered a buying opportunity depending on what kind of return someone's looking to acquire. And we can see right now that at the current share price, even though they've rallied about 35% over the last year, they still, based on these estimates, present a pretty strong buying opportunity. So the next stock that I want to look at is Costco. And we can see that over the last 3 months that Costco is up about 3%, and over the last year, they're up a whopping 73%. They are down about 1% from their all-time highs at the moment, and their PE ratio is about 44.57. And basically how Costco makes money is primarily through in-store merchandise sales in their chain of membership-only big box retail stores. They're the they're the 5th largest retailer in the world, and they're the #1 retailer for organic foods as well as in selling wine, which they talk a lot about in Shark Tank as well. And then we can see from this discounted cash flow model that Costco's intrinsic value per share is about $204 per share, 50% margin of safety, $100 per share. So based on that, it looks like Costco could potentially present an overvaluation at the current share price, which isn't really that surprising considering that their PE ratio is 44.57. So the next stock I want to talk about is O'Reilly Auto Parts, and we can see that they're up in the past 3 months by about 2.5%, and over the last year by about 43%. And they're down about 2% from their all-time highs at the current share price, and their PE ratio is 22.55. And basically, O'Reilly Auto Parts, they specialize in selling auto parts, tools, supplies, equipment, and accessories in the United States for both the professional service sector as well as for at-home customers. And we can see right here that their intrinsic value per share comes out to be about $788.75 per share, with a 50% margin of safety of $394 per share. And so that would mean that they're currently trading at a little less than their intrinsic value, meaning they could potentially, based on these growth estimates from Yahoo Finance, present a good buying opportunity. So the next stock I'm looking at is Arthur J. Gallagher. And this is basically a global insurance brokerage and risk management services firm. They were established in 1927, and they're one of the largest insurance brokers in the world, and their primary revenue source comes from commissions and fees that they charge for their services. Right now, they're down about 1% from their all-time highs, but they are up about 32% over the last year or so, and their current PE ratio is 37.75. And we can see from the discounted cash flow analysis I did, that the intrinsic value per share is about $94 and 50% margin of safety of about $47. And so it looks like it could present a bit of an overvaluation at the current share price. Next stock is Coca Cola, and Coca Cola is up about 5% over the last 3 months, and is up about 19% over the last year. They're currently only down about 4% from all-time highs, and their PE ratio is about 26.69. And Coca Cola, keep in mind, even though their stock price hasn't risen by that much in comparison to, say, Costco 70% and the others with like 30 or upwards of 50%, they are known to be a dividend-paying stock. So the people who buy into Coca Cola stock and invest in Coca Cola aren't really looking for growth in the share price. They're more so looking to get the return through the collection of dividend payments. So the fact that Coca Cola is up 19% and they also pay a pretty hefty dividend is pretty self-explanatory. It seems like it's a pretty good investment, especially because it's beating the overall market at the moment. And we can see from the discounted cash flow model that the intrinsic value per share is calculated to be about $28 per share, 50% margin of safety of $14 per share. So it could present a bit of an overvaluation based on the current estimates. And also, I sort of skipped over this part, but I forgot to mention that they obviously sell Coca Cola. That's probably their most famous beverage, but they also sell other very well-known non-alcoholic beverages like Sprite, Fanta, Diet Coke, and Coke Zero Sugar. Next stock I want to talk about is Novo Nordisk, and Novo Nordisk is up about 7% in the last 3 months, and they're up about 57% over the last year compared to the market's 14%. They're currently down about 5% from all-time highs, and the PE ratio is trading at about 33.24. And basically, Novo Nordisk is a global healthcare company that specializes in diabetes care. They're one of the top 3 largest insulin providers in the world, with the other 2 being Eli Lilly and Sanofi. And we can see that the intrinsic value per share is estimated to be about $16 per share, 50% margin of safety of about $8 per share. So that puts Novo Nordisk, based on these estimates, at a pretty heavy overvaluation. But then again, I'm not sure how accurate some of these estimates are from Yahoo Finance. They said that the growth rate for Novo Nordisk for the next 1 to 5 years would be about 2%. So I'm not sure how accurate that is. And these models do suffer from the garbage in, garbage out theory idea, where basically if we put a bunch of garbage metrics in, then we're going to get a garbage metric out. So obviously, depending on different growth rates, these numbers could change. And I definitely encourage everybody after this video, if they want to further their research, to do more of their own due diligence. The second to last stock that I'm talking about is Keurig Dr Pepper, and they are up about 7% over the last 3 months, and they're up about 9% over the last year. This is actually one of 2 stocks in this list that I left for the end of the video, which are not beating the market at the moment. Keep in mind, the market is up about 14% over the last year, and KDP is only up about 9%. They're currently down about 3% from their all-time highs, and the PE ratio is 25.15. And they're basically one of Coca Cola's biggest competitors. They're a leading beverage company in North America, and they specialize in selling popular beverages like Dr Pepper, Snapple, 7-Up, Canada Dry, Mott's, and A&W. And we can see that their intrinsic value per share is about $14 per share, putting it at a bit of an overvaluation at the moment. And the last stock I want to look at is Deere, which is up 20% over the last 3 months, but they're only up 9% over the last year. But we can see from their 5-year chart that they had a crazy run up from around 2020 to 2021. Insane run up about 275% over the last 5-year period, and most of that came from 2020 to 2021. And we can see that they are up about 22% from their February lows, and their current PE ratio is about 22.52. And Deere is an American corporation that specializes in manufacturing agricultural machinery, heavy equipment, and diesel engines, forestry machinery, and lawn care equipment. And most of their revenues come from the sale of their equipment, as well as, surprisingly, from providing financial services. And we can see that their intrinsic value per share is estimated to be about $177 per share, with a 50% margin of safety of $88 per share. So based on this, it looks like they're currently trading at a bit of an overvaluation. And that basically sums up all of the stocks I wanted to mention in this video. Definitely let me know in the comments section down below any other stocks that have beaten the market and that have strong financial health in the comments section below. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next video.